Thank you for downloading the next installment in my series of short videos on the U.S. economy and the U.S. manufacturing sector. My name is Bill Wood. I am the economics editor for Plastics News magazine. And last week we had a lot of data released that's interesting and useful for the plastics industry in particular, a lot of in-market data on major plastics end markets. So before I get to that data though, I want to just kind of give you a quick overview of what I'm seeing from a high altitude overall, the meta view, if you will. And that is that the economy and the manufacturing sector and the consumer spending data is really starting to feel the weight of the higher interest rates now. I know that it's been a while since the rates have been at this level, and it's taken longer than I thought, to be honest with you, but I can really start to sense that the higher interest rates are weighing on consumer spending, and a lot of the data that we look at for the plastics industry in particular. On the chart, I have graphed the real interest rate on the 10-year note. The real interest rate means it's been adjusted for inflation, and you can see in the past 4 or 5 months that has really cranked up. It's now above 2% on a real rate basis. We flirted with this level earlier this year, and then financing conditions got a bit easier and it came down, and now it's right back up. So this is higher than we really want it to be in the long term, but it's exactly what the Fed had in mind when they're trying to squash inflation, get the rate of inflation down. And so we had some readings on that last week, the CPI, PPI. Those are still showing progress, gradual deceleration in the rate of inflation. The problem is it's not down to where we need it to be yet, or the Fed wants it to be, still in the range of 3 or 4%, depending on what you're measuring, and they want it down to 2. So the risk from here on that is that it re-accelerates and starts to go back up again. I don't see that in the data. And there's also the risk that it goes into a sharp deflationary spiral and goes downward very quickly from here. I don't see that either. So right now it's gradually trending lower, which is ideal, but it's going to take several more months, which means that the interest rates are going to stay at or about these levels for a longer period of time. And hopefully they don't go up. So what would really be helpful is a rally in the bond market, which is entirely possible, and that would keep the 10-year rate down, and it could go down incrementally about the same pace inflation is going down, which means that the real rates stay at or below this level for another few months, which would facilitate that soft landing that everybody's hoping for. And it looks like we're on track for that right now, but again, a lot of stuff to happen before we actually get landed. So let's look at some of the data. The housing starts data really impacted by the interest rates. As I said, that data for the past 3 months has been level, could be worse, not getting any better. We're coming into 2 quarters now, fourth quarter and first quarter, where you really don't expect to see a huge recovery in residential construction activity. These are the seasonally weaker months. So it's going to be at least spring of next year, or maybe even the summer, before we can hope to see a strong recovery in housing starts. A lot of pent-up demand there, but a lot of headwinds as well. Like I say, mortgage rates very high, and some labor shortages in some areas. So if that's your end market, going to have to hang on. Another major end market, automobiles. The data that just came out reflected the strike, and it was a major step down. The auto sector data pulled the entire industrial sector data down. And for the auto sector, they were already ahead for the year. They were doing pretty well, actually. And so the strike was timed in such a way that may not result in a negative quarter or a negative year. Or a real recession, just a blip, if you will. Still have to wait and see. So, but clearly it impacted the October data. And finally we get to the plastics industry data. That data had been trending down, running at about a 6% decline from a year ago. That decline actually accelerated a little bit in the latest data point, thanks largely to the auto strike. So the plastics industry data was not doing well this year prior to the strike. The strike didn't help it at all. The higher interest rates are pulling it down, as are other market forces. And I will talk about the plastics industry data a little bit more in future videos, probably next month in fact. But right now, still looking for that elusive cyclical low point, the turning point. When is this data going to turn back up? It is not. The latest data point was another decline, like I say, attributable to the auto strike, but a decline's a decline, and we'll have to see how long it takes for that data to recover. So, be back in a couple of weeks with a closer look at that type of information. We won't have another data point for another month or so, but we'll have end of the month data on consumer spending and that kind of thing. Till then, I'm going to turn the mic over to grandma and grandpa, aunt and uncle, cousins, and all that. I'm looking forward to having a few days here with a lot of family fun and just making the choice to be grateful. And I wish all of you the happiest of Thanksgiving as well. Thank you.